Last week at the Jackson Hole Symposium, the US Fed Chair Jay Powell said tariffs are likely to have a temporary one-time impact on inflation. Our guest says decreased consumption because of tariffs could be offset by increased investment, and that could spark economic growth in the long term. Let's get more from Tim Murray, capital market strategist in the multi-asset division at Rowe Price. Thanks very much indeed for joining us, Tim. It is interesting. We've heard tariffs generally are a threat to economic growth, but there could be a boost here if consumer spending is depressed a bit, but there's more investment.
Yeah, I think that's really the factor that a lot of people haven't understood, and it's a little bit of a surprise. You know, when tariffs originally came out, Trump was very dogmatic about tariffs, or at least appeared to be. When asked about the impacts of tariff, could it lead to a recession? Was he looking at the stock market? He kind of said he wasn't worried about any of that, that he was fine with negative impacts. But as we've moved forward, we've seen kind of how he's playing this. And of course, initially it was more pragmatic, and the tariff rates came down quite a bit. But the big one was when we got, I think the less understood, but the bigger impact was when we saw the One Big Beautiful Bill passed. And if you do the math on the One Big Beautiful Bill, the spending increases, the corporate tax breaks that are going to come from CapEx to those companies doing CapEx spending, they net out to about the same amount that is being gained in tariff revenues. Mm-hmm. So essentially, whereas I think initially there was concern that it was going to be a drain on the economy, you were going to take tariff revenues, pay down the deficit. Instead, it's really a redistribution of wealth. It's basically, we're going to take the tariff revenues and we're going to use them to incent businesses to do CapEx spending. And I mean, if you think about kind of the long-term growth algorithm there, less consumption, more investment, that should be better long-term for the economy. However, you know, obviously we'll see how that plays out.
It's interesting because the former President, Joe Biden, as you know, pushed through an aggressive, massively expensive industrial development policy. So he put America on course to a big capital expenditure cycle. Now, I guess the current administration has reversed some of that, but it does look like we're going to get a lot of capital investment in the U.S.
Yeah, and it's really just kind of a how do you want to incent it? Do you want to actually give out money to businesses to spend, or do you want to give tax incentives to give businesses to spend? And the Trump administration obviously has landed on the tax incentive side. I think, however, the question mark from here is, will this lead to CapEx that wouldn't have otherwise happened? It's definitely a benefit to businesses because they're going to have higher profits because the tax treatment is going to be better. And the companies that are already doing CapEx, and that's very much the AI side of things, right? So the hyperscalers spending on CapEx, they're delighted to get the tax breaks that are going to come from this. But is it actually going to create new CapEx spending that otherwise wouldn't have happened? I think that's a bigger question. Really, if you think about it, why do businesses do CapEx spending? Generally, it's because they're chasing demand. Generally, it's we don't have enough supply to meet demand. So you probably need demand, an uptick in demand before you really get the impact of CapEx. So it might not happen immediately. It might be more of a gradual process. And so that's kind of what we're watching. Does it actually mean higher CapEx spend than otherwise would have happened?
Looking at the markets, you say they're not screamingly cheap, but you're not worried that we're near a market top?
Yeah, I think so. Clearly, if you look at valuations, they're closing in on all-time highs in a lot of cases, and particularly on the growth side. But the fundamentals, earnings growth has inflected higher. The fundamentals are not only strong, but they're improving, and they have been on a long-term period of improvement for really 10, 15 years. It's been steady improvement in things like ROE, operating margins. They all look good, and there's not a real reason to think that changes in the near term. But obviously valuations are high, so if you have any disappointment, and we saw this in the most recent earnings season, if you do have any disappointments, they get punished really harshly. So it's not a great risk-reward ratio from here. There's more downside than upside, I would say. But the outlook is really strong, and there's a lot of reason to believe we're going to continue to get good news. Or a lot of reason to think we're going to get more good news from NVIDIA. I think probably the outside of earnings season, when investors don't really have any good news to work with, that's maybe when you probably see the weakest period for the markets. That said, you could always have some sort of negative economic surprise, and that changes the game completely.
You think the moment of truth for AI and the massive spending on that is about a year away. The question will be, will users pay for this stuff?
Yeah. So right now, thus far and currently, all of the AI spending is, the vast majority is being done by the hyperscalers. They don't have to take out debt to do it. They have such strong free cash flow. Their existing businesses are so strong that they've been able to finance it internally, right, or organically through free cash flow, which is a big difference between what we saw in the tech bubble. So it hasn't really been debt funded yet. That said, if you look at kind of the CapEx projections, you look at free cash flow projections, we're probably a year, maybe 2 years away from debt being part of this equation. And when that happens, then, so for now, you can sell investors on promise and progress. So, hey, this is the promise of what AI can be, and we're making progress towards that. But once you have debt payments to make, you really need to have profits, right? It's not progress and promise, it becomes profits. And that's when the moment of truth will happen. Now, there's a lot of reason to think at the moment of truth, the answer will be, yeah, AI actually is delivering. But I would say we're probably 2 years away from that point. And so in the meantime, it's going to be a lot more about sentiment and that selling of progress and promise.
It is interesting. I mean, we've got used to getting stuff on the internet for free. I'm thinking about consumers, not customers, but it'll be hard, won't it?
Yeah, exactly. I mean, we're all, a lot of people are now using AI. A lot of people, and when you do searches these days, you get it actually like delivered to you, whether you request it or not. Mm-hmm. And I think people are enjoying that. They're liking what they're seeing from AI. But there's a big difference between trying it out, because why not, and actually having to pay for it. So people are going to need to see the value in it, and especially on the business side. Right now, hey, what we're hearing, the anecdotes are businesses are saying, how can we use AI to improve our businesses? And they're doing that, and they're finding some interesting use cases. That said, has it led to actual cuts in cost? Has it led to cost cutting? Has it led to significantly more efficiency? It's going to actually have to deliver on that so that, like I said, it leads to higher profits rather than just something that's interesting and has promise. And then, of course, for individual users, they're going to have to say, hey, how much do I need this in my daily life? Mm-hmm. And if you talk to a lot of people who are big users of AI, they say, how much would you pay for this? If it went away, if someone threatened to take this away from you, how much would you pay for it? And the answers are pretty much, hey, I would pay a lot. So mm-hmm. There is a lot of reason to think we are going to get that monetization when we need it, but it's still a question mark. We won't know until we get there.
What about the fact that companies will be expecting consumers to deal with AI agents and bots? I mean, one thing I'm interested in is if an AI agent for a company tells you something, can you take that as gospel? Or can you come back at the company if it turns out it was untrue?
Yeah, certainly the issues with hallucinations have been a concern. I think basically what probably needs to happen is some more refinement. Understanding how to prompt AI is going to help out a lot there. But also, I mean, agentic AI hasn't been perfected yet, and that is definitely a step up. I think the more complicated tasks get, that's probably when you start to have a much higher bar for success. Right now, I think there's a runway to having relatively uncomplicated tasks being done by AI, but there's always going to be a human element where there needs to be some human supervision and some kind of grain of salt about, well, do we need to check to make sure this is 100% accurate?
Yeah, but I think it's going to get ever harder to actually get a human being on the phone or a human being who can help you. Anyway, Tim, that's just an old guy grousing. Tim Murray, capital markets strategist in the multi-asset division at Rowe Price. Thanks very much indeed.